For the last few years, borrowing money felt almost, well, cheap, right? It kind of became the new normal. But what if I told you the golden era of low-interest home loans, those super affordable car EMIs, and just incredibly easy credit is quietly coming to a screeching halt? We all pretty much assumed interest rates here in India had hit rock bottom. We thought they'd stay comfortably low for years. But behind closed doors, the Reserve Bank of India just dropped a very serious warning. So, welcome to this explainer. Today, we're breaking down a massive piece of economic, banking, and personal finance news that is absolutely going to directly impact your monthly household budget. So, is the era of cheap loans actually over? Well, the short answer is yeah, it certainly looks like it. The official minutes from the RBI's recent Monetary Policy Committee meeting were just released, and the message buried inside? It's literally sending shockwaves through bond markets and bank boardrooms. See, the public-facing announcement felt like a total nothing-burger, but the actual meeting minutes suggest something totally different. They're secretly signaling that the central bank is actively putting interest rate hikes back on the table. And why should you care? Because every single percentage point they move dictates exactly how much of your hard-earned money leaves your bank account at the end of every single month. Here's how we're going to break this all down today. First, we'll look at the RBI's secret warning. Then, we'll do a quick refresher on understanding the repo rate. After that, we'll dive into why inflation is surging right now, what the actual impact on your wallet is going to be, and finally, why it's time to recalibrate. I promise we're going to translate all that high-level central banking jargon into the exact realities of your personal finances. Okay, let's dive right into our first section, the RBI's secret warning, and the really dramatic shift happening behind closed doors. So during the August Monetary Policy Committee, or MPC meeting, the six-member council voted unanimously to keep the benchmark rate unchanged. On the surface, it looked like totally business as usual. But the internal discussions painted a completely different, highly concerning picture about the state of our economy. Right now, the benchmark policy repo rate sits at 5.25%. The central bank had actually lowered it to this level back in February, back when things were looking great. But today, RBI Governor Sanjay Malhotra and external policy experts have explicitly warned that the scope for any further interest rate cuts is entirely gone. And let me just emphasize how incredibly rare this is. Central bankers are famously cautious, right? They usually prefer these vague hints over definitive statements. So when they explicitly declare that the window for cheaper loans has officially closed, it is a massive blinking red light for the entire economy. So how exactly does a tiny decision made in a boardroom in Mumbai alter your monthly household budget? Let's move to our next section, understanding the repo rate and how central banks control your money. Before we talk about why rates might go up, we really need to understand the mechanics here. The MPC has a primary legal mission: keep retail inflation at a target of 4%. Why 4%? Because that's generally considered the sweet spot for a developing economy. It lets businesses grow and wages rise without completely crushing consumers at the grocery store. And their primary weapon to hit this delicate balance? The repo rate. So what exactly is this repo rate? Think of it like a wholesale price for money. The acronym actually stands for Repurchase Agreement Rate, but simply put, it's the benchmark interest rate at which commercial banks like SBI, HDFC, or ICICI borrow short-term money directly from the central bank. This rate creates the absolute floor for the cost of money in the country. It dictates exactly what commercial banks pay to borrow, which, you guessed it, ultimately dictates the precise interest rate they turn around and charge you for your personal, consumer, and home loans. Think of the Reserve Bank of India like the central water reservoir of a massive city. And commercial banks are basically the neighborhood plumbing pipes. When the RBI opens the main valve, water just flows freely. We get cheap loans, high growth, and easy credit. You can buy that new car or house easily because money is practically overflowing. But if way too much money floods the economy when actual goods and services are in short supply, it sparks a runaway fire of inflation. To stop that fire, the RBI has to close the valve. They hike the repo rate. Suddenly, borrowing becomes incredibly expensive, everyday spending slows down, and it eventually starves out and cools down that inflationary fire. Which brings us to the core of the issue today. The central bank doesn't just change its mind for fun. Over the past few months, the macroeconomic environment has completely shifted, and it's forcing this new hawkish stance. Let's look at Section 3, why inflation is surging, and the dual threat driving up prices. The RBI is effectively getting ready to close that valve, and we need to understand exactly why. Just take a look at this alarming cause and effect loop. Back in February, headline consumer inflation was sitting at an unusually benign, ultra-low level of around 2%. Honestly, everything seemed perfectly fine. But by July, it surged back up to 4.45%. And even more concerning, the central bank's internal models project that inflation is going to climb even further, hitting a dangerous peak of 5.9% in the third quarter. That is uncomfortably close to their absolute legal maximum threshold of 6%. If inflation crosses that 6% line, it means the central bank has essentially failed its mandate, which triggers mandatory explanations to the government. So what in the world is causing this massive spike? Well, it essentially comes down to two huge shocks hitting at the exact same time. First up is the external shock. India imports nearly 90% of its crude oil, and escalating geopolitical conflicts in the Middle East have severely disrupted global maritime shipping lanes. Cargo ships are literally being forced to completely reroute their journeys around the entire continent of Africa. This adds weeks to their travel time and millions of dollars in extra fuel and insurance costs. Naturally, this has sent international crude oil prices climbing rapidly. And when global oil spikes, our domestic transport fuel, shipping logistics, and manufacturing costs all instantly become far, far more expensive. And that brings us to the second shock, the domestic shock. It's not just oil, it is our very own food supply. The MPC members pointed out that erratic, totally unpredictable rainfall during the monsoon season, combined with lingering extreme weather anomalies, has created absolute havoc in the agricultural sector. We are seeing wild volatility in essential vegetable prices and incredibly unstable food grain supplies across the entire country. And hey, remember that oil shock we just talked about? When diesel prices go up, trucking companies charge significantly more to transport these already scarce vegetables from the farms into the cities, which just causes your retail food prices to climb even higher. This perfectly sets up just how severe the situation is. Let's read this exact warning from RBI Governor Sanjay Malhotra straight from those official minutes. He states, "The scope for any further easing does not seem to exist, may suggest a recalibration of the policy rate." Okay, let me translate that central banking jargon for you. The word recalibration is universally understood by financial markets as a massive red flag. It's basically the polite central banker way of telling absolutely everyone to brace themselves for rate hikes. And let's move to an even bigger fear for the central bank, second-round effects. Deputy Governor Poonam Gupta and internal member Indranil Bhattacharya pointed out their deep fear of inflation becoming de-anchored. Second-round effects happen when businesses permanently raise consumer prices to protect their profit margins against all those rising fuel and raw material costs we just talked about. Think about it like this. If you expect milk, bread, and rent to be significantly more expensive tomorrow, you're going to ask your boss for a raise today, right? Well, that raises business costs, which forces them to hike retail price tags even faster. It creates this brutal, self-fulfilling inflationary spiral that the RBI absolutely must crush by raising rates. Which brings us to the most important part of this entire explainer, the ultimate so what question. Let's look at Section 4, Impact on Your Wallet, and what this actually means for your daily life. How does a central bank hinting at future rate hikes in some dense PDF document actually alter your personal savings and debts? Okay, if you're a borrower with a floating rate home loan or a car loan linked to the repo rate, the news is, well, it's bad. Higher repo rates mean your bank is going to immediately increase your interest rate. You are going to face either a higher monthly EMI payout, or your bank will just silently extend the total tenure of your loan by several months, meaning you end up paying years more in total interest. You really need to calculate a budget buffer right now. Sit down, look at your monthly expenses, and figure out exactly where you can cut back if your housing payment suddenly jumps by a few thousand rupees. But if you are a conservative saver, there is a massive silver lining here. When rates go up, commercial banks compete aggressively for your retail cash. This means much higher returns on fixed deposits. Retirees and savers finally have a golden opportunity to lock in predictable, higher-yielding interest. It's wild to think about how incredibly interconnected all of this really is. Step 1. A distant geopolitical conflict in the Middle East disrupts shipping. Step 2. Global oil prices inevitably rise. Step 3, that makes transport and food costs climb right here in India. Step 4, to fight that resulting domestic inflation, the RBI hikes the repo rate. And Step 5, that higher rate trickles all the way down to a higher EMI being automatically deducted from your personal salary account. Understanding this domino effect is exactly how you protect yourself and your family's finances. That brings us to our final section. Time to recalibrate and preparing your personal balance sheet. The RBI's August MPC minutes have made one thing crystal clear. The window for cheap rate cuts has officially closed. Persistent energy costs and food price volatility have put future interest rate hikes squarely on the table. While they're currently just maintaining a watchful stance, the warning signs are flashing bright red in their internal minutes. Now is the time to review your debts well before that valve gets closed. So I want to leave you with this final provocative thought. Now that you know the RBI is preparing for potential rate hikes to fight off inflation, what is your next move going to be? Are you going to scramble to prepay a portion of your existing home loans to escape those higher EMIs? Or are you going to seize the moment and lock your spare cash into those high-yield fixed deposits? Let me know your personal financial strategies down in the comments. Thank you so much for joining me for this explainer. Stay focused, stay informed, and I will see you next time.